Hi, welcome to the Rule Based Trader Learn and Earn with me free options trading for beginners course. In previous introduction video, I have debunked some of the major myths in options trading. Now, let's look into how stocks versus options are being transacted in the marketplace and what exactly is an options contract. Let's dive in. How are stocks, or you can call it shares, being transacted in the marketplace? It requires two people, buyer and a seller. Suppose the seller owns a stock whose value is 100 rupees and buyer wants to buy it and seller is willing to sell it. Buyer simply has to give 100 rupees to the seller and seller will hand over the stock to the buyer. It's as simple as that. So, what is an options contract? Let's take the same example. Now, pay very close attention. I am going to go very slowly so that you really understand what is an options contract and how it is different from stock trading. Here also two people are required to make an options contract. There is a buyer and there is a seller. Suppose the stock value is 100 rupees. Let's say the buyer wants to buy the stock. Buyer wants to buy that stock, but not for 100 rupees and not now, but in near future. Suppose say 5 days from now. You may ask, why will the buyer wants to buy at a higher price 5 days from now when it is available now at 100 rupees? It's because the buyer thinks that the stock will be valued more than 120 rupees 5 days from now, which can be 130 rupees, 140 rupees, 150 rupees, 200 rupees, or anything above 120 rupees. In this case, buyer comes into an agreement with the seller, which is known as the options contract. This options contract says buyer has the right but not the obligation to execute this options contract within the specified time period. This means that buyer has an option of right to buy that stock or execute this options contract if its value goes above 120 rupees, and at the same time buyer is not obligated to execute this contract if the value of the stock stays below 120 rupees within the time period. Why would the buyer wants to execute the options contract and buy the stock at 120 rupees when it is below 120 rupees, which will make him the loss? If at all if he still wants to buy it, he will buy at the marketplace which is lesser than 120 rupees. So what's in it for the seller here? For the seller to come to this kind of agreement or an options contract with the buyer, seller demands certain price as he is taking the risk of selling the stock at predetermined price within the time period, even though if the stock goes above that price, taking a loss. This certain price that the seller takes from the buyer in options terminology is called as premium, and the time period that we are talking about here is called as expiry, options contract expiration date. He collects the so-called premium from the buyer to come into this options contract with the buyer. Let me give you an example so that you will understand more deeper. Buyer comes in contract with the seller which says buyer has right but not the obligation to buy the stock at 120 rupees within next 7 days or by expiration date. For this options contract, buyer pays 10 rupees, suppose say 10 rupees premium to the seller. Let us now look at two scenarios. Let us now look at two scenarios. Which can arise from the options agreement between the buyer and the seller. Scenario number 1. Suppose, say, the stock price goes to 150 rupees. Within the specified time period agreed between buyer and seller as per the options contract. Then buyer will simply execute this options contract and buy the stock at the predetermined value from the seller, which is 120 rupees, and then sell to someone else at the marketplace at the market price of 150 rupees by making 20 rupees profit and not 30, which you might be thinking 150 minus 120 is 30, because here as per the options contract and rules, the seller gets to keep the premium that he received, which is 10 rupees. So the buyer will get a profit of 150 minus 120, again the 10 rupees that he paid to the seller, which is equal to 20 rupees. Let's talk about scenario number 2. Suppose say the stock price is just at 115 rupees and has not crossed 120 rupees at the end of the time period as per the options contract. As the buyer has right but not the obligation to execute the contract, buyer will simply not execute the contract to buy at 120 rupees as the stock is now available at 115 rupees itself. In this case, the seller will get to keep all the 10 rupees premium that he has received from the buyer, which is a profit for him. That's This is it in very simple terms. So here is a quick recap. After executing an options contract, buyer or the seller of the options will have four options: buy if you have sold it, sell if you have bought it, hand over the rights within the expiration date to someone else, just to hold on to them till the expiration date. These above options, these above four options gives you enormous amount of opportunities to make money if you understand and use them correctly. So now that we have learned what is an options contract in basic terms, in next episode I am going to teach you options terminologies. What is call option, put option, buying and selling of call or put option, options chain, in the money, at the money and out of the money options, expiration date, option Greeks, etc., etc., etc. Please stay tuned for this. I am going to teach you in very practical and simple terms. Once after I teach this option terminologies to you, I am going to teach, I am going to take a practical example and take you through each and every step, whatever we have learned till now. So please stay tuned. And here is a little standard disclaimer for you. And thank you so much. Please like, subscribe, and share with the like-minded community of traders who wants to learn options trading. Thanks again.